In the span of just a few weeks, from October 2025 through early January 2026, every major technology company has updated their capital expenditure guidance for 2026. The numbers are staggering in their consistency. Meta announced that Capex would be notably larger in 2026, with Morgan Stanley modeling a 39% increase in Capex spending. Microsoft signaled aggressive Capex growth continuing into 2026. Amazon indicated Capex would remain elevated. Google and Apple followed suit. But here's what the headlines aren't highlighting. When Capex spending accelerates faster than revenue growth, profit margins collapse. And when profit margins collapse across the Magnificent Seven simultaneously, stock valuations that are priced for steady earnings growth face a mathematical cliff. The first quarter 2026 earnings season will be the moment when this margin collapse becomes visible in official financial reports. For someone in retirement, understanding what that means for your portfolio is critical. Let's start with the mechanics of what's happening. Meta's Capex guidance for 2025 stands at $70 to $72 billion, up from the previous guidance of $66 to $72 billion. For 2026, management stated that Capex would be notably larger than 2025. Morgan Stanley analysts estimate that larger translates to approximately $97 to $100 billion in Capex for 2026, a 39 to 42% year-over-year increase. That's extraordinary. Meta's revenue last year was approximately $134 billion. If Capex grows to $100 billion, Meta would be dedicating 75% of its operating cash flow to Capex before accounting for taxes, interest, and shareholder returns. But Meta is not unique. Microsoft, Amazon, Google, and Apple have all committed to similarly elevated Capex spending in 2026. The consensus estimates from Wall Street show the big five hyperscalers will collectively spend approximately $600 billion on Capex in 2026, up from $443 billion in 2025. That's a 36% increase in aggregate AI infrastructure spending. Now here's the critical question. Will revenue grow 36%? History suggests no. The average revenue growth for these companies is approximately 10 to 15% annually. If Capex grows 36% while revenue grows 10 to 15%, profit margins compress dramatically. Let's model this with actual numbers. Suppose a company generates $100 billion in revenue with a 40% operating margin, creating $40 billion in operating profit. Capex is $40 billion. Free cash flow, operating profit minus Capex, is zero. They're spending all their profits on capital investment with nothing left over. Now in 2026, revenue grows 12% to $112 billion. Operating margin stays at 40%, creating $44.8 billion in operating profit, but Capex grows 36% to $54.4 billion. Free cash flow is now negative. They're spending more on Capex than they're generating in operating profit. The company must borrow money or reduce shareholder returns just to fund the Capex increase. This is exactly what's happening at Meta, Microsoft, and the other hyperscalers. The scale of Capex is growing faster than the scale of operating profits. This is mathematically unsustainable indefinitely. Eventually, the company has two choices: reduce Capex growth or accept negative free cash flow indefinitely. What this means for earnings is that the reported profit margin, the percentage of each revenue dollar that flows to the bottom line, will compress as the company incurs increased depreciation on the growing Capex base. A company that reports 40% operating margin when Capex is $40 billion will report lower operating margin when Capex is $54 billion, assuming the same revenue base. Here's where the analysis becomes critical for retirement portfolios. The analyst community has not yet incorporated this margin compression into Q1 2026 earnings forecasts. Wall Street is still modeling 2026 earnings growth of 10 to 20% for the mega-cap tech stocks, despite the fact that Capex guidance suggests profit margins will compress. That's a massive disconnect. When Meta reports Q1 2026 earnings, investors will see two numbers that don't reconcile: strong revenue growth, approximately 12 to 15% year over year, paired with disappointing profit margin contraction due to elevated Capex and depreciation. The market will reprice downward as it realizes earnings growth is being offset by margin compression. The depreciation impact is particularly important. When a company goes from spending $40 billion annually on Capex to $54 billion, the accumulated depreciation from that Capex base increases. Let's say Meta adds $14 billion more Capex. That $14 billion depreciated over 5 years creates approximately $2.8 billion in additional annual depreciation expense. That $2.8 billion in depreciation flows directly to lower reported earnings. For context, Meta reported operating profit before depreciation of approximately $35 to $40 billion in 2025. An additional $2.8 billion in depreciation represents roughly a 7 to 8% reduction in reported net income, all else equal. Applied across all the hyperscalers simultaneously, the aggregate impact on earnings is massive. This is why the first quarter 2026 earnings season is likely to shock investors. Companies will report strong revenue growth because the businesses are genuinely growing, but earnings will disappoint relative to expectations because margins have compressed more than analysts projected. This phenomenon is called earnings surprise to the downside. Revenues beat estimates, but earnings miss because margins were worse than expected. Research from JP Morgan shows that 2026 consensus earnings estimates have been revised upward by 3.4% for the Magnificent Seven, while the broader S&P 493, the rest of the market, has seen estimate revisions downward by 1.2%. This suggests that analysts are still optimistic about mega-cap tech earnings growth in 2026, despite the Capex guidance suggesting margin compression is coming. That disconnect between analyst expectations and the mathematical reality of Capex growth outpacing revenue growth is the setup for Q1 2026 earnings disappointment. What happens when tech earnings disappoint in Q1 2026? Historically, tech stocks correct 10 to 20% on earnings misses, especially when the misses surprise analysts who had been revising estimates upward. If the Magnificent Seven represents 35 to 40% of the S&P 500, a 15% decline in the Magnificent Seven translates to a 5 to 6% decline in the overall index. But typically, when megacap tech underperforms due to earnings misses, the rotation drives broader market selling as well. The actual correction could be 10 to 15% for the overall market. For a retiree, a 10 to 15% portfolio decline in Q1 2026 is manageable if your portfolio is properly allocated to bonds and cash. But if you're 100% in equities, a 10 to 15% decline combined with your 4% withdrawal rate creates sequence of returns pressure that's difficult to recover from. The margin cliff is about to become visible. The question is, will you be positioned defensively before it arrives, or will you be forced to react after the decline has already occurred? Here's the critical timeline. Q4 2025 earnings will be reported in January and early February 2026. These will show the businesses still operating at previous margin levels because they're reporting on fourth quarter activity before the full Capex acceleration. But forward guidance for 2026 Capex spending is already in the public domain. Meta has already told the world Capex will be notably larger. Morgan Stanley has modeled the 39% increase, and other companies have similarly signaled elevated Capex ahead. Sophisticated investors know this margin compression is coming. They're beginning to reduce their positions in mega-cap growth stocks. This rotation is already visible in the market. While the Magnificent Seven stocks have risen in late 2025, they've lagged the broader market. Smaller cap stocks and non-tech stocks have outperformed. That's the smart money rotating out before the earnings season makes the margin compression official. By the time Q1 2026 earnings arrive in late April and May, the margin compression will be mathematically undeniable. Companies will report earnings that are lower than consensus expectations because of the Capex-driven depreciation impact. The market will reprice downward. The question for retirement portfolios is, will you have already repositioned defensively, or will you be selling at a loss after the decline has started? For someone in retirement or approaching it, the next 90 days, through early April, represent a critical window. The information about Capex acceleration and margin compression is already public. The market hasn't yet repriced. This is your opportunity to rebalance your portfolio, reduce concentration in the mega-cap tech stocks that are most vulnerable to margin compression, and increase allocation to defensive assets. Specific actions worth considering. First, reduce your S&P 500 index fund exposure or increase your allocation to non-mega-cap index funds that have lower concentration in the Magnificent Seven. Second, add 18 to 24 months of living expenses to cash and short-term bond allocations so you're not forced to sell stocks when market declines occur in Q1 and beyond. Third, review your withdrawal rate assumptions. If you're assuming 7% returns to support a 4% withdrawal, and 2026 earnings growth is likely to be 5 to 10% due to margin compression, your math is off. Consider reducing your planned withdrawals or delay retirement if you haven't retired yet. Fourth, understand that this margin compression is not permanent. It's a multi-year phenomenon as Capex spending plateaus relative to revenue growth and the depreciation base normalizes. But the near-term earnings pressure is real and stock markets will reprice downward to reflect that pressure. The margin cliff is real. It's visible in the Capex guidance data. It's obvious when you do the math on Capex growth versus revenue growth. The only question is whether your retirement portfolio is positioned defensively before Q1 2026 earnings make it official.